So guys, today we have to do second chapter of your quantitative methods book, right? So it's QM 2, second chapter of your quantitative methods book, which is called the time value of money in finance. This chapter has two modules. One is your discounted cash flow valuation. Second is your implied returns and cash flow additivity. Now this module, this particular chapter is quite long, right? There are a lot of new things here, especially if you are new to finance or if you are someone who has not seen the financial instruments. You might get confused because they are referring to a lot of different instruments, and you need to know those instruments also, right? You don't need to go too deeper, but at least you need to know the basic definition. Okay, very, very important. So we have decided that we will cover this module in two parts. We will do module 1 today. We'll cover this chapter in two parts. We'll cover module 1 today and module 2 tomorrow. Okay, so that's the logic, and you can go back and check your planner. This week I think you have class every day, right? So remember that part. Okay, very, very clearly. Fine, so let's get started. We have to cover module 1 only, but try to understand it, guys. One more thing which I want to add here is, first of all, please apply the scholarship. I think tomorrow is the deadline, so apply the scholarship. Second part is that initially we are going slow, we are not going very fast, so try to get adjusted with the pace, try to understand the concept, get familiar with the calculator, get familiar, like, get yourself organized, right? The logic here is that it's very important that you are very well versed with everything, because after that, slowly the speed of our studying and teaching will gradually increase, right? So keep that in point in mind. All right, so as I told you, I think Sanyam has joined little later, so I have told very clearly that this chapter is very long. There are a lot of new financial instruments which I have to explain. There are some calculations also, so we'll cover this module in two parts. Module 1 we will do today, module 2 we will do tomorrow. Okay, so let's get started, guys. Fine. So the first topic is the module 1 which you are covering today is your discounted cash flow valuation. Okay, now only four topics here. Discounted cash flow, right? Discounted cash flow, basically DCF, right? You might have heard this word used a lot, DCF, right? DCF, right? Many times, even if you go to different careers, it's not only important for CFA, but let's say you try to make a career in investment banking after your MBA, or you try to make your career even in your venture capitalist industry or private equity, etc. DCF is a very common model, discounted cash flow valuation. In fact, this is one of the most basic fundamental valuation which we study in finance, right? So a lot of people build these discounted cash flow models in their Excel and Python, etc. So that is what we'll try to understand today. So one of the most fundamental things in finance. And to understand that, we'll try to understand the relationship between your present and the future values. We'll try to understand some fixed income securities, equity securities. We'll try to understand what is preferred and common stock. And we'll also go to equity security valuation using your dividend discount model, right? So one model we'll try to introduce. Okay. Given on your intake, if you're able to understand it well, we can go ahead also, right? It's not necessary that we have to cover this much only, but objective is that we need to maintain balance between your understanding and my speed, right? Especially in the initial day, right? Once we get comfortable with each other, then we can take at a higher speed, right? All right. So let's try to understand the relationship between present and future value, right? So the basic concept, if you are new to finance or if you're not studied this concept any time earlier, it's a very simple concept, right? From our parents' time or even before that, right? What we have seen, right? What our parents used to do was take our money and get to the bank, deposit that money in fixed income, and come back and tell us that, I have deposited so much money at your name, and after 5 years or 10 years, you will get that much amount of, value, right? That much amount of money, right? So what was that? Let's say, just for your knowledge, our parents used to go to bank with, let's say, 100,000. 100,000 means your 1 lakh rupees, right? So, and then come back and tell us that, okay, I have deposited this money in your fixed income, and after 5 years or 10 years, you will get some money, right? Some amount. So today is, let's say, your 10th of November 2025, and I have deposited the money for 5 years, and after 5 years you will get the money called, right? That you will get the money, some X amount of money, right? So how this X amount of money used to be calculated, like, as simple as a young child will ask his parents is that how is this calculated? So, the simple way is that after first year, the money will, let's say, the money is earning interest at 8%, right? So it will be what, 1 lakh rupee 100,000 into 1.08. So after your first year, the money will become 108,000, right? Now after second year, how much the money will be? After second year, the money will be 108,000. This is the starting balance. Then again 8%, right? Third year, what will be the money will be, right? 108,000 into 1.08, which was there after second year, into 1.08, right? 1 plus r, right? What I'm doing is I'm multiplying by 1 plus r, right? Every year. Fourth year, what will be the thing? Fourth year, same this money, right? Do, right? And into 1.08. Fifth year, what will be the money? Fifth year, right? Again, fourth year money, fourth year amount, right, into 1.08. So what you are, this is what our parents used to do, right? It's very simple kind of understanding. This is what the final. So what is the answer to this question, that how much money will be there of 1 lakh after 5 years? So simple answer is that we are taking the present value. We are taking the present value 100,000. Sorry, let me rub it. So 100,000 and 1.08 raised to power 5. That's it, guys. Future value and present value are not a very difficult concept, right? People in finance make it very difficult. They make it sound that, oh my God, I don't know what is future value, present value. But you think this is what our parents have been doing, even though our parents were never in finance, right? Most of our parents were never in finance, right? Yeah, even the most basic education parents, like, used to do this for their kids, right? They used to deposit money. At least my parents did, right? And I'm pretty sure your parents also did that, right? Because in our parents generation time, this was the only way they investment. Then they never, unless somebody is rich, they understood stock market. But middle class or lower middle class, a little bit upper middle class also, they understood this principle only, right? That whatever salary is coming, take out some money, go and deposit in the bank, create a FD, right? That was the basic thing, right? And I'm pretty sure, most of the Indians will clearly understand that this is how it works, right? So again, right, this is what is your future value and present value, right? Present value is something which is today's money, right? 100,000 is today money. Future value is something which will be the money after some years, right? And this is what is happening. Future value is what? Future value is what? The present value, which is 1 lakh rupees, this much, right? This much, 1 lakh rupees, right? And then you are multiplying by what? You are multiplying by 1 plus r raised to power t. T is what? 5 years. So 1 plus r is 1.08 raised to power t, 5 years. That's it, guys. Now somebody will say, okay, tell me the present value, right? So you can play it both sides, right? You can say that, okay, if I know the present value, I can find the future value. But mathematics works both ways, right? If you know the future value, you can find the present value also, right? It is just, you have to divide it, right? If I have to find the present value, you will do what? You will future value, you will divide by your 1 plus r raised to power t, right? This method, right? This thing is, when you try to go ahead, right? Let me make another slide. When you try to go from today's value to tomorrow's value, right? When you try to go from today's value is present value. If you're trying to go from today's value to tomorrow's value, tomorrow means next day, tomorrow's value, right? So that is future value, right? So this is called compounding. This is called compounding. When you are going from tomorrow's value to today's value, this is called discounting, right? So compounding and discounting are like heads and tails, right? If you are going from today's to present value to future value, that is called compounding. If you are going from future value to present value, that is called discounting, right? Now the question comes is that, okay, fine, we understood that it is very straightforward. If I have 1 lakh rupees, you can predict. If I have, let's say, for 5 years thing, if I have today your 100,000, if I have 100,000 amount today, right? If you have 100,000, right? I know that, okay, in 5 years, right, that will become 1 plus 8%, right, raised to power 5. If I know few, so this was present value, multiply 1 plus r, I got future value. If somebody says no, I the future value, find out this, then I know that, okay, whatever my value is, right, future value, I divide it by 1 plus r raised to power t, and I'll get the present value. So both way it works fine, right? Both way it works perfectly fine. So that is good. Okay. So keep that in mind. Now the question comes is compounding only one kind of thing, right? Is it is there any uh, is there anything we should understand in compounding also? So compounding is also two types, right? Compounding is your discrete compounding and continuous compounding. Right. Discrete compounding means you're saying that compounding is happening, you know, annually, right? You say, the compounding period is annually. Then you say semi-annually. Then you say quarterly. I think we discussed this last time also, quarterly, right? Or daily, right? Continuous means it is happening every moment, right? Every moment it is happening. That is why here future value was present value exponential RT, and here in the discrete one, it was future value equal to present value 1 plus r raised party. Right. So that is what we need to remember. Okay. So don't get confused. It is very easy. I think pretty straightforward. If you have any question, you can ask. Right. So that is what is the logic here, guys. Continuous compounding, discrete compounding, very basic, very simple stuff. Right. So keep that thing in mind when you are doing the questions. Okay. This is what, again, you know this is how the calculation is, and when you're trying to find PV, it becomes FV divided by ERT divided by exponential ERT becomes raised to power E minus RT, right? So that is what it becomes. Okay, moving on. So this is what I have explained. So this is what I can write here also. One small thing I have not written earlier, but if I have to find, let's say, PV is equal to FV divided by exponential RT, right, which is FV exponential minus RT, right? So this is what we have. All right. Now we are getting into little deeper way, right? That was very simple kind of explanation. Now we are getting into the explanation mode for a particular product. Right? We'll try to understand a particular product, especially in the fixed income security, right? Now, the whole idea is, see, what I want to stress here, right? Please understand my perspective here. You have a topic called fixed income. See, you have a topic called fixed income. That is why Pratik also dropped you a message that a lot of concept will be touched in this topic. If you go and there's a message of Pratik, I think last week, that in QM2, this chapter, there are a lot of concepts which are described as fixed income, which might overwhelm you, and you will say, think that, oh, I don't understand anything and I'm not understanding anything in class. Have patience. See, quantitative methods is what? It's a technique which is applied on a product. Fixed income security is a product. Quantitative method is a process. Process is applied on a product, right? So be very clear, right? So one is a process, one is a product. Now the problem here is we are learning process is quantitative methods, product is fixed income. We are learning how process is applied on this product. But problem here is that right now we don't know too much about the product. right? So I have to complete the chapter because you have to start somewhere, right? So right now, what I'll do is I'll tell you very basic things about product. I'll tell you very simple things about product. There are many more things about the product, but that we will discuss when we go into the product chapter, which is the fixed income, right? We will not go into the product description. We'll not think too much about product right now because right now our main motive is understanding how the process is applied to product, not the product. For understanding of the product, understanding of fixed income, we have a separate topic we just study later. Okay. So fixed income securities are, again, fixed income securities sounds very fancy, right? Oh, fixed income security. Fixed income security was nothing but our parents did, right? Whole their life. They took the money to the bank, deposited the money, and you earn interest. That's a fixed income product, right? So fixed income, my parent would not have known fixed income whole their life. They would have not understood what is fixed income, right? But whole their life they used fixed income products. Whole their life they deposited money in banks, made FDs. So that is fixed income. Fixed income product is somewhere where you put your money and there is an interest which you get every year or every semi annual kind of thing. So where the issuer agrees to pay back borrowed money with interest. So issuer is your banks, right? When we used to go to bank, right? Right now we don't get anything normally. Right now they say that, sir, please open your app, you will see that you have a FD there, right? But when we were young, at least I have seen that my father used to have a suitcase, right? In that I knew that that suitcase contains all the money related things, right? So whenever my father used to open that suitcase, then I used to see that that suitcase has, a lot of papers, right? So there will be a paper, some. So there will paper. My father will say like this, right? See, I have deposited 50,000 for you, and 50,000 for your brother. We are two brothers, right? So 50,000 for you and 50,000 for you, and that will become some amount in after 5 years. Then he will show me another. I have done this in SBI. I have done this in PNB. I have done this in that bank, that bank. So this is my memory of my parents, right? So they used to do like this, and I'm pretty sure your parents also did something similar, right? So what I'm trying to say is that that time they used to get paper. That time, I'm talking about many 20 years back. That time they used to get a piece of paper. In that piece of paper, it was written that, okay, Mr. So and so has deposited so and so money on so and so person names, and he's the nominee. And after 5 years, bank promises to pay this much amount of money to this person, right, on this day, right? So some kind of paper, right? So that is what, right? So fixed income securities are financial instrument where the issuer means SBI or bank, which is taking your money, agrees to pay back borrowed money, that full money will be paid back with interest. And in this chapter, we'll only study about bonds, right? Bonds is something, again, bonds is not like your FDs. Bonds are your different instruments. I hope you know that bonds are generally, again, bonds are piece of paper only, but they are issued generally by companies where they issued bonds and they state that how much, you know percentage they will give, right? So bonds are one of the most simplest kind of fixed income instruments, right? The first kind of bond we need to study is zero coupon bond, right? Zero coupon bond is a bond which is paying zero coupon, right? Again, you will see this name for the first time and you might get confused that what is zero coupon bond. But please understand, bond is a very simple product. Let me go ahead and tell you. When we talk about a bond, right? I'm just assuming that you don't know, that's why I'm putting it, but I'm pretty sure a lot of you are very smart to know what are bonds, etc. So bonds are one of the most simplest financial instrument. What happens in bond is that, bond is issued by, can be issued by anyone, right? It can be issued by government, right? Those are called India, those are called GSEC, government securities. US, those are called treasury bonds, right? And treasury bonds also have different categories. You have your notes, right? Treasury notes, right? You have bills, right? And you have bonds, right? So again, when we reach there, I'll tell you more about it, why they differ. Basically, they differ by the maturity, and they can be issued by corporates also. Corporate means any company. Reliance issue bond, right? Your Apple issue bond, right? Meta stock has fallen, Facebook stock has fallen almost, you know, 15%. Facebook stock has fallen. Why? Because they're planning to issue or bonds, right? So again, bonds can be issued by corporates also, government also, your IMF also, your World Bank also, right? So these are called supranational bonds, right? So there bonds, there is no issuer can be anyone, right? The whole point here is, and the basic logic here in bonds is that bonds is the piece of paper. Basically, what is a bond? Bond is a piece of paper between issuer and investor. So investor is someone who is investing his money, right? So investor is giving his money to the issuer. In turn, issuer is giving investor a piece of paper, right? And that piece of paper is called bond, right? Bond is called piece of paper, right? And they, in the that piece of paper, it is written that okay, how much interest will be paid. It will be paid semi-annually, annually. What are the conditions? Where it will, where the bond will cease to exist, or something, right? All everything will be put in detail, right? So those kind of thing, right? I'm not again not going too much in detail because that will create super confusion, which we don't want to do right now. But idea here is to understand very very clearly that when a bond is finally, the deal is done. It's a two parties, one party buy the bond and one party sells the bond. Ultimately, let's say there is a 5 year bond, right? It's a 5 year bond, and let's keep it very simple that it's a annual coupon, right? Coupon is paid annually. So what happens in a bond, right? If it is a this is today we bought the bond, so 1 year, 2 year, 3 year, 4 year, 5 year, right? So it's a 5 year bond. And what is happening in 5 year? That let's say it's a uh, dollar terms $100,000 bond, and you say that the amount of interest. Let's keep it very very simply. I by Y. I by Y is your the yield generally, right? It is dependent I by Y. It's 10%, right? So what are we saying here is that 100,000 into 10%, which means it is what 10,000, right? So 10,000 comes every year as a coupon. So 10K comes here, 10K comes here, 10K comes here, 10K comes here, and last you get 100K also and 10K also, right? So this is how the money comes back in a bond, right? Bond has a coupon where the money comes periodically as a coupon, right? So this is a normal coupon paying bond. Okay, but it's not necessary that all bonds are like this. There is another category of bonds which are called your ZCB, zero coupon bond. Now, what's the speciality of zero coupon bond? Zero coupon bond has zero coupon. The name itself says zero coupon. Now you are saying, sir, what do you mean by zero coupon? Just now you said that I will get some money every, 1 year. You are saying now I'm not getting money any year, right? So why should I buy the bond? So these zero coupon bonds are a special category of bonds where what happens is that eventually at the end you will get your 100,000 complete money. But these zero coupon bonds are generally issued at discount, and quite a steep discount, right? So they will be issued here at, let's say, uh, what you say, uh, 79%, 79,000. So bond will be issued at 79,000, and eventually after 5 years you will get 100,000. So you see, effectively you invested 79,000, you got 100,000, right? Which is more than greater than 20% yield, right? So now you will say, sir, why would somebody buy or sell such kind of bond, right? There are different motives, like buyer, the person who buys the bond is someone. Okay, uh, let me explain. I'll come back to your question. Let me complete the thing, you will understand. Okay, so what I want to add here is that basically the bond has been issued at discount, let's say 79,000, and eventually after 5 years you get 100,000. Now the two question comes to everybody's mind here, that why would somebody buy this kind of bond, and why would somebody sell this kind of bond? Buyer, the question first comes is that why would somebody buy this kind of bond when he's initially investing 79,000, getting later 100,000? One way to look at it, he's saying that okay, fine, yield is very good, right? Yield, the amount of money you are making is almost greater than 20%, right? Which is awesome yield, right? Awesome kind of deal, which is not happening in other scenarios, right? So that is one thing to consider. That is really great. But another point which is coming is that you're not getting any periodic cash flow, right? You're not getting anything after 1 year, 2 year, 3 year, 4 year. Then generally this is done by these kind of bonds are, just a second guys, why my screen has gone blank, what has happened? Why my screen has gone blank? Can you see my screen? Okay, fine, something happened.
It is closed, sir.
Screen is closed. Yeah, it's gone blank for me also. Hmm. Can you see now? Yes, no.
No, sir, still frozen.
Okay, let me share again. Suddenly it went blank for me also. Some connection issue maybe. Let's try again. Just let me know, guys, because I'm sometimes you get busy in teaching, you don't realize what is happening. Wait, wait, wait. What just happened? This was creating problem in. Okay, I think I understood. Now you can see. Yes or no?
Yes, sir.
Right. So now the question comes is that why would somebody invest in such kind of bonds, right? So I told you logic, right? The basic logic here is that people are saying that, oh, you are getting a good deal, right? So you're getting a good deal, you are very happy. But there is a opposite point also. Opposite point here is that you are kind of, what you say, not getting any, no interim cash flows, right? Now, who will like such kind of thing? See, such kind of thing is generally liked by your pension funds. Why pension? Come on, what is happening here? Let me just give me a second. I'm. I think Pratik is also using it. Let me ask him. Is he also using this page? But two users might be creating a problem. So let me ask him. I think it should be fine now. Okay. Now you can see.
Yes, sir.
Fine. So what I was saying was that there's no interim cash flows, right? There is no interim cash flow, so that's a matter of concern for people, right? Okay, so that's if it goes away, please tell me. Okay, so no interim cash flows. Generally, who will prefer such kind of thing? Generally, pension funds will prefer such kind of things. Why pension funds? Because pension funds are funds which are giving money to your pensioners after a certain years of, they retire after 55 years, 60 years, whenever, right? So pension funds generally operate like this. Pension funds already know that today these many employees are working with me, they will retire after these many years, so I don't need any money in between, I only need money at the last. So right, so they plan, pension funds plan like that, right? That okay, they don't need money in between, they need money only at the last. So good for pension funds. Now the question is that who will sell such kind of bond? Why would somebody give such an awesome yield and everything? Generally distressed companies, companies which are distressed today, right? They are going some kind of problem or there is some cash flow issue, etc. They will generally prefer to issue a zero coupon bond because they believe that okay, let us issue right now. Next 2 3 4 years, we don't have to give any coupon, any money in between. Then in next 3 4 years, my situation will become better, and at the end of 5 years, my situation will be better. I can pay back the full money, which even though I have to pay at a higher interest rate, but I will be able to pay that, right? So that is the logic of these things. Now the cross question which comes here, I'm playing just a devil's advocate here, right? The cross question comes here that, sir, why are we teaching this, right? What is the incentive of learning zero coupon bond, right? See, zero coupon bond are very important in the world of finance for a particular reason, right? Why it is very important, please understand this, a lot of people don't know, especially when they are starting their understanding of these chapter, because it's a very common point, na, sir, that you can ask me that, sir, we just started quantitative methods. In quantitative methods, the first product you are teaching me is zero coupon bond. Why are you teaching me zero coupon bond? Why are you not teaching me, coupon bonds? Why are you not teaching me some other kind of bond? What is like why, what is the reason of teaching zero coupon bond initially, and why so much love for zero coupon bond? So there is so much love for zero coupon bond. The logic here is that zero coupon bond are actually used a lot when we are trying to understand the pricing and valuation of bonds. Why it is used a lot? The logic here is that zero coupon bond only has, right, zero coupon bond only has one thing to look for, right? That is that since zero coupon bond does not have any interim cash flows, right? Only the final cash flow, only final cash flow, which is this one, no interim cash flow. So zero coupon bonds mathematically are quite easy to understand. And since they are mathematically quite easy to understand, that really helps us because we don't need to worry about that what will happen to this, how much is the present value of this, what is the present value of this, what is the present value of this cash flows, right? So basically, whenever we are studying valuation, whether we are studying pricing, we always start with zero coupon bond because zero coupon bonds, since they have only one cash flow, and that cash flow is also, right, only the end cash flow, right, only this cash flow, right? So there is a ease of understanding, right? There is a ease of understanding, and that ease of understanding, right, helps us to, what you say, understand the bond valuation in a much better way, right? That is why we start with zero coupon bond, because there is no cash flows in between, and that makes it super easy to understand. Okay, fine. So now, going here, now you understand zero coupon bonds are sold at a discount to the face value that I told you. Investor return come from the difference between the purchase price 79,000 to your 100,000. right? Received at maturity. That I also told. The bond do not pay any periodic interest. That I also told. The discount rate in this case is called yield to maturity. Now, see, zero coupon bond. I told you, right? It's a very, you know, very important thing to understand when we're trying to understand the valuation, the pricing of bond, and the discount rate, right? The rate which we use, the discount rate which we use in zero coupon bond, that is called your YTM. That has a special name. That particular discount rate is called your yield to maturity. Now, don't be surprised here, guys. I don't want to go too deep, but see the logic in understanding your bonds is that in bonds world there are different names for different yields, right? See, one of the most common name is discount rate or interest rate, right? One of the easiest name to understand is that it is the discount rate, right? But as we start studying deeper and deeper, we realize that okay, there are different kinds of rate, right? Rates are, have a lot of names, right? You will see something called spot rates. Spot rates are nothing but your zero rates. Zero rates are nothing but your rates on zero coupon bonds, right? The other name for that is your YTM also, yield to maturity, right? So not the other name. I'll not say other name. In fact, that uh, is wrong thing to say to be fair. But spot rates are your zero rates which are on the zero coupon bond. When you know the spot rate and zero rates, this can help you to find. This can help you to find a rate called a rate YTM, yield to maturity. Now, yield to maturity is very important concept again, guys. Yield to maturity. I'll explain you. But I'm telling you that you will get another rate, yield to maturity rate. Similarly, in rates world, there are many other rates. There is something called CY, current yield, right? There is something called par yield. There is something called forward rate, right? There is something called OIS rate. There is something called swap rate. OIS and swap rate are very simple. This is overnight index swap rate. That's a simple swap rate. So these are very similar in nature, right? There is OIS rate, swap rate, current yield, par yield, forward rate, uh, which is other any other OIS, par, current, YTM, par yield, current yield, YTM, uh, spot, forward. I think most of them are covered. There is something called repo rate also. Repo rate. Repo rate. There is something called reverse repo rate also. Right, and we'll see if I remember anything more. Right. So what I'm trying to tell you here is that when we go to the world of yield, you will realize that there are different names to different yields, and it's not that they are entirely different, right? The whole idea is that if you know the zero rate spot rate, you can find the yield to maturity. If you know yield to maturity, you can find par yield also. If you know OIS rate, you can find some other rate, right? So there is an interrelationship also, right? Don't think that these things are totally independent. I'm just giving you an extra idea. You will study all these things in fixed income chapter, but what I'm trying to put across here is that these all things have your interrelationship also. So don't forget that they are not totally independent. Now, the next point which I want to highlight here is uh, if you go back here, the discount rate in this case called is yield to maturity for this instrument for a zero coupon bond with annual compounding, face value plus YTM raised to power n is equal to ZCB value, right? Now, this is again interesting, right? What we are saying here now, please note very, very clearly that what we are saying that a zero coupon bond value is equal to your face value plus your YTM raised to power n, right? So what are we trying to put? See, YTM is yield to maturity is that rate which, just understand, YTM is that rate which makes the current market rate, basically current value, right, which makes the current value, right, equal to present value, current value equal to the present value of cash flows, right? Or current value means market value equal to present value of cash flows. Okay, so that is your YTM. Okay, YTM is that rate which makes market value, or which is also called current value, equal to present value of cash flow, right? So now, in this is the basic definition, guys. Now, what is the cash flow in zero coupon bond? How many cash flow in zero coupon bond?
One.
One cash flow, right? That cash flow is what? The face value, right? That the face value you are getting at the last, right? Which is your 100,000, right? So face value, right? And then you are saying that basically YTM is that your rate that I am dividing this one cash. See, uh, I'm making all these pages because you are new to this world. If you know it, that's very nice. But if you don't know it, I don't want to skip it because that's a very basic understanding you need to develop. So basically, idea here is that in zero coupon bond, you look at it. Zero coupon bond, you have 0, 1, 2, 3, 4, and 5. No cash flow here, no cash flow here, no cash flow here, no cash flow here. Only one cash flow which is coming, which is that 100,000. Now you have to discount it, right? This is what I told you now. Ultimately, you have to discount it. Discounting. You have to discount it. What is the fund of discounting, guys? Tell me. If I told you, if I have to find out the present value, what was it? Future value 1 plus r divide raised to power n. Yes or no? Simple, na?
Yes, sir.
Right. So, what is the face value of future value? Future value which was coming was 100,000. Right, 100,000 is there, right? And 1 plus r. I am saying this r is actually YTM, right? This r is known as YTM raised to power n, right? N is 5 years, and it is giving me present value, right? So the YTM, or present value is what? Present value is zero coupon bond value, right? So this is zero coupon bond value. So basically, when I do, if you look at it again, when I do PV is equal to FV 1 plus R raised to power N. The R, please understand, the R, the definition of YTM is this, please understand. YTM is that R, YTM is that R which makes the uh, which makes the market value equal to present value of cash flows. I'll give you an example now, right? So again, if you take the example, simple logic, zero coupon bond, I told you, right? I'll make the zero coupon bond and both comparatively. So here things were easy. 1, 2, 3, 4, 5. So here it was kind of easy, right? There was no difficulty at all here. Okay. So here thing was that I was only receiving 100,000. This 100,000 I'm saying I'm discounting. So thing was very easy that I need to find the zero coupon bond value, right? That will be equal to what? My 100,000 which is coming, right? And it is divided by 1 plus r raised to power n. And if I put YTM here, if I substitute r by YTM is that value. By definition, YTM is that value which makes the your zero coupon bond value. We can find out. Let's say if there was a coupon paying bond, right? Just let's say 10K is coming here, 10K is coming here, 10K is coming here, 10K is coming here, and 100K is here, right? So what will you do? You will discount by this. You will say, sir, I have five cash flows. I have to discount all five cash flows, right? So basic principle here is that you are discounting all five cash flows, right? When I say all five cash flow discount, so you will say, sir, first cash flow I have, that discounting is 10, 1 plus your sum rate, right? Sum rate raised to power 1, 10K, 10,000, 10K, 1 plus R, sum rate square. Then 10K, 1 plus R, sum rate cube. 10K, 1 plus R, sum rate 4. And finally, 110K, because 110K is also coming here. 110K, 1 plus R raised to power 5. So, and if somebody tells you that, the present value is whatever, right? So basically, if present value is given to you for 100K bond, the present value, let's say, is given to you 96,000, right? 96,000, right? So you will say 96,000 equal to this 10K 1 plus R raised to power 1 plus this one plus this one plus this one plus this one. Okay. So what is R here? What is this R? This R is equating the present value with the market value with the present value of cash flow. So this R is called YTM, right? So I am trying to explain you YTM, right? Nothing else. I'm just trying to put it very clearly what YTM is. YTM is that magical number, that magical thing, right? Which is, if you put in denominator under every cash flow, you will get the present market value of that bond, right? So it's a hypothetical number. YTM is not observed in the market. YTM is a number. See, basically, we were like that. Okay, we have seen so many different rates, right? We want one single rate by which, when we discount all the cash flows, we get the present value, or we get the present value of the bond, right? So I think I have taken a lot of time to explain this. I hope it makes sense to you. If it doesn't, don't worry. These kind of concept will come again in fixed income. You don't need to go that much deep, which I have tried to go here, right? But the whole idea is that don't be surprised when you see your such kind of formulas, because this formula is nothing but a simple explanation of this difficult thing, right? So this is what I did with you, right? Just now, face value plus 1 by YTM raised to power n. The yield of a zero coupon bond can be calculated from the above formula. The question has been given. Consider zero coupon bond, price is given to you. So this is the market price. The price is given to you, right? The face value is 100, right? Face value should not be 100, actually it should be 1000, because price is your 555.26, right? So the face value has to be in the four digits, 1000, right? So it's 1000. And the annual compounding over 100 years, right? There's something wrong here, I think. um, it should be there's some calculation mistake, guys. It should be 15 years, right? This should be n is equal to 15, right? N is equal to 15, right? Payment is equal to 0, PMT is equal to 0, and we can calculate yield using your calculator as follows, right? See, again, you have to use calculator. Keep in mind, the bond has a price. Price is the present value. Always put the present value as negative, right? If you put it as positive, you'll never get the answer, guys. Remember, your future value and present value should have opposite signs. Please keep in mind very, very clearly. I have shared with you time value of money calculator, lectures. Go back and watch it. Very, very important to remember. Present value should be put negative. Future value should be put positive, right? So don't mess this sign. If you mess this sign, your calculator, the problem is it is the setting of the calculator. Your calculator inherent setting is that if you put value positive, calculator will think that it's a future value. So if you want calculator to think it is a present value, you have to put a negative value, right? Keep that in mind, setting in the calculator, right? And then PMT, you have to do PMT because there is zero coupon bond, PMT is zero, right? And then number of years is 15, right? This question was wrong, so I've corrected 15. And then you press compute your I by Y, right? You will get 4 as the answer, right? Please go back and learn this today, right? Very, very important. In calculator, these are time value money calculation. You remember the sheet I have given you, 1300hours.com. Sophie Lauren or something was the author. I told you, right? This sheet I use in for my exam. There also time value money calculation is given. Please learn the time value money calculation. Always remember, out of these 5 things, if I know 4 things, I'll be able to get the fifth thing, right? This is very common. Time value of money is very important to understand. You need 4 things to get the fifth question, but there is a trick also here. Sometimes what happened is they give only 3 things here. They generally will not give you FV, right? If they don't give you FV, then you can, if it is 4 digit, put 1000 as FV, right? Like if it is triple nine, if it is 999 or 1000 something, then put FV as 1000. If it is 99, 98 something, put FV as 100, right? So sometimes they don't give you FV, then you can assume FV also, right? Which is the face value, right? So face value is something generally for all the calculation we take as 100 or 1000, right? 100,000, 10,000. We generally round it off to 100,000, 10,000, depending on what is the present value, right? So if face value is not given, don't panic. Face value you can assume. So generally 4 things should be given, but sometimes they give you 3 things. You should understand. In some case, interest rates can be negative. A zero coupon bond with a negative yield would be priced at a premium, which means its price is far greater than its face value, right? But it's very rare. You will rarely find a zero coupon bond priced at a premium. Means which is saying if the interest rate is negative, people will say the zero coupon bond is 1,10,000, and in the 5 year you will get 1 lakh. But that doesn't make sense economically. That if that happens, that has to happen in a country like Japan where interest rates are negative. Otherwise, that will not happen. Okay, and that too, rate negative was long back, not now, 3 4 years back, but not now. Okay, so we have studied a lot. Right now, we discuss quite deep stuff. Let's go ahead, right? So this is what we have. So I think I have explained you quite well. So fixed coupon bond, I told you already. In a coupon bond, investor receive a cash interest payment, which I told you when I build you that diagram that you have periodic cash flows, right? Every 1 2 3 period, you will get some cash flows, right? Learn to build the timeline, guys. This helps you to visualize things very, very good, right? So we'll build a lot of timelines. A bond's coupon rate is the percentage of the face value, which I told you, and determines the amount of interest payment. A 3% annual coupon, I told you, 1000 bond, pay 3% of 1000, which is 30. Valuation of fixed, I told you how to do valuation. Valuation, I have covered already. This all thing I have covered already, guys. Valuation is this one. This is the valuation of your coupon paying bond. This is a coupon paying bond, na? This is a coupon paying bond, right? Right. So this is the valuation. This is the valuation. It is being talked, right? All coupons you add, right? All coupons and then the final face value. Some people write this thing as two different things. Some people will write it 10K 1 plus R raised to power 5, and then they will write another part as 100K 1 plus R raised to power 5. So don't get surprised if somebody write like this. That's just a stylish way of writing the simple thing, right? What they are doing is they are putting 5 coupons. just added 10 plus 100, right? 10 plus 100, I have added and written under 10, directly under 10, right? So you write it separately or you write it together, it doesn't matter. Okay. So that is the coupon paying bond valuation. All right. So this is the valuation coupon paying bond. This is what they're doing. All coupon 1 by R raised to power 2, which I did, right? I did the same thing, na? 10K 1 plus R, right? Raised to power 1. 10K 1 plus R raised to power 2. 10K 1 plus R raised to power 3. 10K is 10,000. I'm just, because this pen hangs a little bit when you write too much. So I'm just trying to, again, same thing. No, I think that's fine now. Yeah. Something is issue. I'll figure out what is happening. Right. Come on. I'll ask nobody to use it. I think somebody is using it, this software, because this is a licensed software. If two people work in it together, it kind of hangs. So I think somebody is also working. I'll convey to Pratik that nobody to work when I'm taking the class. Right. So 10K 1 plus R raised to power 4 and 10K 1 plus R raised to power 5. And finally face value. So this, right, this is coupon was this, right? Coupon was, all these were coupons. These are all coupons, guys. These are coupon part, right? This is coupon part, right? First part. Face value part is 100K 1 plus R raised to power 5. So it's a very fancy thing written in a, you know, it's a very simple thing written in a fancy way, I would say. Okay. Now the next part, definition part.
Sir, could
Again,
you present your screen? I mean, it went off.
again, it happened. Sorry, please. Yeah, thank you for telling me. No, just keep on happening. I'll tell them. I think somebody is using it. I called, but he didn't pick up. But I'll convey not to use. Okay. So the whole idea is that this whole thing looks very difficult, but it's very conceptual and very easy to understand. Right? Don't get too disturbed by this. Then the difference between coupon rate and yield to maturity. I told you, right? There are many rates. I told you, right? Coupon rate is coupon, right? Coupon rate is how much you are earning on the coupon. So I told you, right? 10% coupon, 10% interest you are earning. If you have bond 100,000 bond, 10% coupon is how much you are earning interest on how much you are giving coupon to the client, right? So it would 10% means 10,000 coupon is coming. So this is coupon, right? Whereas your yield to maturity, I told you it's a hypothetical rate which is when put in the denominator, this R. This is your yield to maturity. One rate, single rate, right? Single rate by which you divide, and you are able to get your single rate by which you divide, and you are able to get what? Your present value of cash flow equal to the market value, right? The price and the yield of a bond are inversely related. That also is a relationship. You must remember that very common relationship, that when yield goes up, price goes down, right? When yield goes down, price goes up, right? Like today's, what is happening is, today the news has come that US government shutdown will end. So what has happened, as soon as the news broke out, the yield went down in US market, yield went down, the price of the bonds went up, right? Yield went down, price of the bond went up. And I have told many times also, not you guys, but I've told you, right? uh, uh, Basically this is a relationship in the bond market. The yield goes down, the price of the P is the price of the bond, guys. Don't be surprised. P is the price of the bond, right? Goes down. This is universal relationship, guys. Every time holds, right? Very common. Today, this is happening in US market. The yield has gone down, price of the bond is going up. because US shut down. US stock market is also up, and when yield goes down, generally stock market also goes up. But I'm not listing out that because there are some caveats there. But when the price decreases, the yield to maturity increases. When the price increases, the yield to maturity increases. This is a universal relationship, right? But please understand, yield here is YTM, P is the price of the bonds. Okay, so keep that in mind. Then moving ahead, fine. Next one is another different kind of product, again in the fixed income space, perpetuity. Perpetuity are basically perpetual bonds. Perpetual bonds are those bonds which has no maturity date. Now, this sounds very funny, sir. How can a bond be there which has no maturity date? Generally, nowadays such bonds are not issued, but those bonds have been issued sometimes and the history also. So there's some bonds which are no maturity date that make payments indefinitely. Now that sounds very ridiculous, but that is the case. Present values can be calculated using a simplified formula, but future value is not a meaningful concept for perpetuity, right? So this is a very common thing which comes in exam. Present value of perpetuity. Just remember, perpetuity is a bond which just pays interest rate, right, but never pays you your principal backs, pays you your what you say, the coupon, right? Pays you your coupon continuously, but never the principal, right? So means it is continuing till indefinitely. And the formula is your payment, whichever is coming, divided by R. Again, you have to remember. I am very irritated by this thing today. I don't know what is happening. Let me sort out this tomorrow. Something or the other is happening. Okay, fine. Perpetuity is equal to payment divided by R. We'll figure out, guys, what is happening here. Tomorrow onward, this will not be the problem. I don't know what is going on. Okay, this is what. Then we have something called amortizing bond, right? This also sounds very difficult concept. Amortizing bond is just when you think of amortizing, right? It is like your EMIs. Just when you heard or when you hear a word called amortizing, just think of your EMIs for your home loan or something. An amortizing bond is one that pays a level amount each period, including its maturity period, right? So amortizing is you are paying like an EMI, right? What happens in EMI? You pays if anybody has taken loan EMI, right? You pays little bit of your principal amount also every period and major chunk of your interest amount. And as soon as you initially what happens is you pay major chunk of initial interest, little bit of principal, and when you cover few years, then interest portion is finished, you only pay the principal portion, right? What is the difference between amortizing bond and a fixed in coupon bond? For an amortizing bond, each payment includes some portion of the principal and in interest. If you have not taken a loan, you might be you aware not aware that much. But if you have taken a loan ever in life, you go and check your loan schedule, right, which the bank gives you. You'll realize that let's say your EMI is 50K, right? If your EMI which is going for 50K, you will realize that bank will say that out of 50K, let's say for example hypothetically, 45K is towards the interest payment, right? 5K is towards the principal payment, right? So this is how it will move down, down, down. And when first the interest will finish off, then the main principal will finish off. Go and check, just Google your loan, how loan payments are structured in India or worldwide. It's a EMI. Amortizing bond is your EMI, right? The fixed coupon bond, the entire principal is paid investor on the maturity date. Amortizing bonds are example of an annuity instrument. Annuity instrument is Annuity is an instrument. What's the annuity? Anybody knows? Annuity is very common instrument which is used by your especially life insurance company. Life insurance companies sell annuity products also. Annuity products is right. All these names sounds very tricky, guys, but again, don't worry about too much. Annuity products are when you will,
Lump sum.
yeah, lump sum. Annuity products is that you LIC and all that says to you, na, you come and deposit you know, certain amount of money with us, and first 5 years will not pay you anything. Your first 10 years will not pay you anything. After 10 years, we'll start paying you monthly pension of something, something, right? So that is your annuity product, right? For annuity product, each period is calculated as follow. Annuity payment. This also please remember, right? This also please remember. See, these two formulas are mostly of academic interest, but see, some question comes in exam and you need to solve it. So just this is very easy. This is, I don't think there should be any difficulty here, but this is little tricky. Annuity payment is R rate of interest rate into PV, your 1 minus 1 plus R raised to power minus T. 1 minus 1 plus R raised to power minus T, R into PV. Okay, so that is what we have. And then we have practice question. Now let's try to do these practice question, tricky practice question, guys. Okay. Uh, Grupo Ignacia issued 10-year corporate bonds 2 years ago. Okay, fine. The bonds have an annualized coupon of 10.7% on a semi-annual basis. Do you remember this? Annualized coupon, but a semi-annual basis means for the full annual, it full year it is 10.7, but that is paid in two parts, right? So means 10.7 percentage divided by 2, right? So every 6 months you will be paid 5.35, 5.35 in 6 months, right? So that is the frequencies, right? So remember this part. And the current annualized YTM is 11.6%. Okay, YTM is 11.6%. The current price of the Grupo Ignatius bonds per MXN 100 of par value is closest to. Now, this is tricky, right? This is tricky, and this is how the question comes in exam, guys. This is where you need to focus on, because when you try to understand your CFA, right, you will realize very clearly that in CFA, right, you need to know how to apply the concept which you have studied in a very holistic way, right? And that's why we have chosen the questions for your understanding, very high level question, right? We have not chosen feather question to teach you, because we wanted you to do actual question of exam, and actual question of exams will be like this only. So first part to understand here is that coupon payments which are happening will be 10.7 divided by 2. So your it is 5.35 coupon payments. Similarly, now the discount rate. When I say the discount rate, because the annualized current annualized YTM is your 11.6%. Now, same logic, if your annualized YTM is 11.6%, what is the YTM per period? Your period is 6 months. So we will divide 11.6 also by 2, right? So we'll get 5.8. And how many periods we have? What is the number of years? 2 years ago the bond was issued. How many years are balanced? 10-year corporate bond, 8 years are balanced. So balance years are 8 years. So you know, so okay, let me write this much, you will understand. Okay, what I'll do is, guys, my pen is little hanging here, right? Due to, I don't know what is the technical issue. What I'll do is I'm copy pasting this question, and I am taking you to OneNote. OneNote pen will not hang, right? So I can make good diagrams, and I'll share the what you say, the PDF in the group, so you can uh, you know use that for your practice, right? We have time also, and as I told you, right, we CFA is all about practice, right? 40% is the time you should dedicate to theory. 40% is time you should actually dedicate to solving questions, and 20% is the time you should dedicate to revision. So it has to be very active learning. You cannot do your passive learning, right? So what we will do is that, let me shift my screen and let me take you to your OneNote, right? We'll keep coming back here, but right now I'll take you to OneNote where I can write easily. Some technical issue normally doesn't happen, but it's okay. We have alternative also. Okay, fine. So I'll share this, but now copy pasted the question. Now let me do solve it here. Okay. Now listen to me carefully. The bond was originally, right? Originally, the bond was 10-year bond. See, CFA ask you good question, right? Very, do less question, but do high quality questions, right? Read the question carefully. 10-year bond. Okay, fine. So this is how I solve an exam if I am a student. 1 year, 2 year, 3 year, 4 year, 5 year, 6 year, 7, 8, let's say 9 and 10 year. Okay, fine. 10-year corporate bond 2 years ago. Okay, so it was issued here, but today I am here. Okay, 2 years ago, means I am standing here. This is my position today. Bond was issued here, right? So write down here, bond issued. A bond issued here, right? But today I am here. This is today. 2 years ago, the bond was issued, na? With me till now? Yes? The bond
Yes, sir.
pays an annualized coupon of 10.7%. Okay, you say, okay, coupon is 10.7% on a semi-annual basis. Okay, that troubles me. I told you, right? Coupon is coming semi-annual. That changes a lot of things. Now you change it. Oh, coupon is coming seven. Like, so it means coupon will come here, coupon will come here, coupon will come here, coupon will come here, here. So coupon will come at here also, here also, here also, here also, here also, here also, here. So basically, coupon will come. We have 8 years which were remaining, and semi-annual coupon is coming. So I am getting 16 coupons, right? And what is the coupon I am getting? Because this is annualized coupon. This is a coupon is given annualized. Per annum coupon is given, right? So, but coupons are coming. What? 16 coupons. Coupons coming semi-annually. Why semi-annually? Because this is written semi-annual basis. Semi-annual. Fine. So coupons are coming semi-annual, 16 coupons. So I'll say, okay, full year coupon is 10.7. Semi-annual coupon is SA is semi-annual. Semi-annual coupon is 10.7 divided by 2, which is 5.35%. Fine. That is my calculation till now. And the current annualized YTM is 11.6%. Current annualized YTM. See, current annualized YTM is 11.6%. But I don't need annualized YTM, right? Why? Because my coupon I am considering 5.35, which is semi-annual. So I need my YTM also semi-annual. So I'll say, okay, give me YTM also semi-annual. Why should I see if my coupon has been annual, right? Then I would am fine. But my coupon is not semi-annual as per the question. So I want YTM also semi-annual. So 11.6% divided by 2. So this gives me 5.8%, right? So we have solved now two interesting points of your understanding. We have solved your, what you say, your coupon payments. We have solved the YTM, right? And number of periods is also 16. Now we have to do what? What is the question asking me? The question is asking me that uh, the current price. The current price means you are asking me the present value, basically, right? You're asking me the present value to calculate, and you are telling me that please calculate it, right? So I'm like, okay, fine, that I'll do, right? So let me, what you say, when you try to find the present value, how will you find the present value, guys? What's the logic of finding present value? What do you do for finding the present value?
Discounting the
Yeah,
future.
discounting, right? Discounted cash flow, right? That was the whole logic, right? The module name is discounted cash flow. So I'm like, okay, fine. You want me to find discounted cash flow? I know how to find out. So my simple logic is that okay, what is my cash flow? My cash flow, which is coming, the first time period, right? If I'm sitting here, my first cash flow, which is coming, right, is your 5.35. So my 5.35 is my cash flow divided by my YTM, which is semi-annual, right? So, or you can see the logic is there are two ways here. Either you use okay, maybe you will get confused. So I
Sir,
just want to
wasn't
say
5.35 the interest, so why are we taking it as a future value?
no 5.35 is the coupon, na. The coupon is coming. So what I'm saying is okay. I'm not written the full thing, right? Just wait. What I'm trying to say is 5.35 is the coupon which is coming here, right? First cash flow, right? First cash flow. Okay, let me write equation first. So I have 16, so I will write CF1 1 plus your YTM, right, raised to power 1. CF2 1 plus YTM raised to power 2. CF3 1 plus YTM raised to power 3, right? I will do, and last one will do CF16, right, 1 plus YTM raised to power 16, right? So this is what, right? Ultimately, this is my generic equation, right? This is my generic equation of solving your what you say, the uh, the present value, right? Am I right? The present value will be solved like this, na. uh, okay. So I think your network issue would be there. Here it is fine. So the point here is that I have to take the present value of the cash flow, right? Okay. So this is what I'll do is I will again paste this question below. This one is this till this much. I think you are guys are fine. Now what I'm doing is, so if you have understood this, now I'm trying to summarize and do the calculation again because I just want you to understand it properly, right? Because initial days. So what has happened is now you are clear that 2 years have passed. We are here, we are standing here, today is here, right? I have 16 cash flows: 1 2 3 4 5 6 7 8 9 10 11 12 13 14 15 16, right? This is 3, this is 4, this is 5, this is 6 7 8 9 and 10, right? So this is today, this is 10th year, right? Now I'm saying I have 16 cash flows. Ultimately, I have to do what? Every cash flow has to be discounted. Na? Are you getting my point? Yes or no?
Yes, sir.
Right? Every cash flow has to be discounted, right? So every cash flow, what is my cash flow? Cash flow is a coupon. Na? Cash flow is coupon. Or what was the coupon I calculated? Coupon I calculated was 5.35. So 5.35 is the coupon coming. 5.35. Right. So 5.35 divided by what? 1 plus. Now this discounting creates a problem. Now here students get very confused that, sir, what should I do? So this I want to tell you. See, there are two ways to do it. One is you take the full year YTM. One way. One way is you take the full year YTM. So you take the full year YTM which is given to you full year, right? That is 11.6%. Then you say that okay, it is divided by 2 because your what you say, or okay, let me make it more simpler, right? you do what? See, cash flow, you know that coupon, total coupon divided by 2 because semi-annual. Similarly, 1 plus YTM divided by 2, it is semi-annual. Then you know that it is 6 monthly because the cash flow is coming 6 monthly, it's 0.5. And yesterday, or I don't know, you guys know it or not, but the whole idea is when compounding and discounting we studied last week, uh, then I told you very clearly that when we try to find the compounding part, we do this now 1 plus r by m into n. Yes or no? So zero point 0.5, whatever I am dividing here by 2, this will get multiplied by 2, right? So then this I have to do for 16 cash flows, right? All 16 cash flows, right? And then I have to do last one will be my face value. There also I have to do same thing, 1 plus YTM divided by 2, 8 into 2. So if you see the equation which will come out after all this is, will come out like this: 5.35, 1 plus 5.8 percent, right, raised to power 1. 5.35, 1 plus 5.8% square. 5.35, 1 plus 5.8, right, raised to power 3, right, percent. 5.35, 1 plus 5.8% raised to power 4. And similarly, I'll go till the last one. And last one, if you want to separate it, so I can separate it also. Last one, 5.35 plus 5.8% raised to power 16 plus your 1000, no 1000, what is the uh, face value here? It will be 100 of par value, na? 100 of par value. So it is 100 plus 5.8% 16. This is my equation, guys. This equation you have to solve in your calculator, right? This equation, because if you start solving it uh, in your what you say, you try to solve it simply by pen and paper, it will take a lot of time. You have to solve this equation by your calculator, right? That's how it will be done. So if you solve it, your value will be, the whole thing is, uh, the calculation of whole thing will boil down to your something like closer to 95.39, right? So that is what we want. And I think uh, the current price of bond is closest to your 95.39, right? So that is what we will get. Okay, so we'll go back to the
Can I ask a
solution,
quick
but
question?
please ask the question.
Yeah, what is the logic behind dividing the YTM by the coupon to arrive at the price? I may have missed if you explained that part.
Yeah. So I'll tell you, right? This is the most confusing part also. So I'll go down. And please understand, everyone else, this is very, very confusing to be fair. See, the logic is apple to apple comparison, right? It is very, what you say, in the finance world, we say apple to apple or orange to orange comparison. That if my coupon is becoming semi annual, I'm doing coupon is becoming semi-annual. The discounting of that coupon has to be done by semi-annual YTM. Okay, because both were. This was also given you in annual way. This was also given you in annual way, right? But you, as a principle, it was told to you that this is semi-annual. Now this has been given to you semi-annual in the question. Question says to you that coupon is coming semi-annual, right? So question says to you, coupon is coming semi-annual. Now, if that is the case, okay, no pen is working here, but if that is the case, semi-annual basis, right? So you have to make your YTM also semi-annual. Okay, so it's that logic, and the principle to the top is that since it is semi-annual, right? Since this is semi-annual, okay, the time period will depict semi-annuality, right? The semi-annual. So time period will be zero point 0.5, but the logic which I told you last week was in discounting was, please remember whenever we are doing discounting and compounding, if we are dividing a rate by a discount factor, right? Quarterly, monthly, semi-annual, always remember that you have to multiply the time period by that. This is the general principle, guys. If you are dividing here by m, you have to multiply by here. So 2 gets divided here. This is semi-annual. Semi-annual is 6 months. Na? 6 months will be 0.5. 0.5 into 2. So this is the logic. Coupon gets divided by, coupon becomes semi-annual. The discount has to be semi-annual because otherwise we are violating the principle of equality or something, because then we are not following the same logic, right? Because ultimately the period is shrinking. What are you doing? You are saying that instead of my coupon coming in the third year, coupon is coming here. If coupon is coming here, you're discounting a shorter distance. No, you're discounting 6 months, right? And if you're discounting 6 months, your YTM also has to become 6 months. Coupon is as such 6 months. YTM also has to become 6 months. Make sense? Does it
Sir,
make
I
sense?
understand the matching part.
Mhm.
That's not the issue. What I couldn't understand is why divide. What's the reason that dividing the coupon payment by the YTM will give us the price? What's the
Okay,
reason
that
for
part.
that?
Okay, fine. Okay, so that part, okay, I'll explain. See, ultimately, we are doing what? We are doing discounted cash flows, right? Discounted cash flow. So the whole logic of discounted cash flow is that you have cash flows which are coming, right? So this was second year, we were here. Third, fourth, fifth, sixth, seven, eight, nine, 10. Then we said that our cash flows came 6 monthly. So we said cash flow came here, 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 here. Now we are saying that what are we trying to achieve here, right? What is the question asking us? Question is asking me that I need to find the current price of Grupo Ignatius bonds, right? Current price. I have been told to find the current price. I told you in the definition of YTM that if the current price, if you go back to the definition of YTM, which I told you, I'll write down here also. The definition of YTM was, YTM is that magical yield. YTM is that magical hypothetical, right, yield. It is not observed in the real world. Yield that makes the present value of cash flows of a bond equal to its current price. This is what I wrote in the definition earlier also. When I'll go there, change the screen, I'll show you. Right. So by this definition, it becomes very clear. Now, if I have to find current price, if I have the cash flows, right? I have the cash flows. If I put YTM here, won't they equate? Because this is what the YTM means, na? This is the definition of YTM. YTM is that magical yield, hypothetical yield that makes the present value of cash flow of a bond equal to its current price. So I need to find the current price. I had the cash flows. then I only need the YTM to put on the formula and get the answer. Make sense?
Makes sense.
Right? So
So is the bond
that's the
market
whole lot.
efficient? Is the bond market efficient enough that in the real world that actually happens?
No, no, no. This is hypothetical, right? See, this is this is YTM does not exist in the real world. YTM is like a value which we have for ourselves created, right? See, you are asking a very technical question, so I'm answering maybe going beyond the scope of the discussion which we are doing right now. Basically, in the real world, there are spot rates, right? Spot rates, which are also called zero rates, which are also called zero coupon rates, right? In real world, you have these rates. So what we have is that you will have 3 month spot rate. So your 3 month spot rate will be something like 3%. Then you will have 6 month spot rate. That will be like 3.2%. Then you will have 9 month spot rate. That will be like 3.4%. I'm just taking easy numbers. Then 12 month spot rate. Then like a 3.6%. Right. So in real world, we will have these kind of rates. So in real world, if I have to discount my cash flows, let's say my cash flows are coming, or let me make it as per the question. Let me make the spot rates simply 6 month, 12 month, 18 month, 24 month. So my in real world, my coupon which came 5.35 here in 6 months, right? That will be discounted by 5.35 plus your spot rate will be semi-annual. So I will use 0.03 raised to power 1. Then my next coupon which came after 12 months, 5.35, that coupon will be discounted by 5.35, 1 plus 0.032 raised to power 1. Next coupon which came after 18 months, which will be discounted by 5.3, 1.034 raised to power a 1, and which one coupon which came after 24 months, which is 5.35, 1.036 raised to power 1. This is what you are asking now. This is what you are saying now, that bond market is not so efficient, right? Because you are getting different spot rates. Okay, so this is what in the reality such kind of thing happens. But what we as practitioners do, which I told you, we as practitioners say that no, we don't want so much of complexity, right? No, see, it is ultimately what are we doing? We are doing quants. Quant is what? Quant says mathematics. Mathematics does what? In a class, when you were younger in school days class, right? You had different students with different marks. What does the teacher tell the principal? Teacher used to tell, na sir, the average student's mark is 80%, right? Teacher never used to tell that the highest student has 100 marks and the lowest student has 60 marks, right? So YTM is like that averaging kind of thing. YTM is like that. I don't want this drama. I don't want 3, 3.2, 3.4, 3.6. This is real life stuff. Real life stuff is this, right? Real life stuff is this part. Okay, this is real life, right? I don't want this kind of drama. I want, tell me one rate which is kind of the rate which depicts everything. So that rate will come out, let's say 3.3. So we are saying that, oh, YTM is 3.3, which is kind of depicting the whole thing. Does it make sense?
Yes, it makes sense.
In the real world, we have spot rates, which are like this, which are changing with time 3, 3.2, 3.4, 3.6, whatever, right? YTM is a hypothetical number, magical hypothetical number, which we have created so that we want to match the cash flows with the current price, and we want to come out with a single number. We don't want this different spot rates for different time period. We want one number, right? Which we can say that, okay, near about this is these are my rates, right? So that is why we do this thing, right? So again, very interesting. And what I want you, please take it as a homework. If you're not able to do, I will do it tomorrow. Take it as a homework. Try to do in calculator. Learn how to do in calculator. Calculator, you have to put the cash flows. It is very easy, to be fair. It's not, you have to put PMT. It's a payment, right? Payment is coming 5.35. Again, you can put present value. You have to calculate present value. So PV you have to find. FV is equal to 100, right? I by Y in your calculator will be 5.8, right? Don't put the percentage sign or don't put 5.8 directly. 1, 2, 3, 4. What is left? N is equal to 16. Why n is equal to 16? This is number of time period. Just put this in calculator, right, and compute PV. Right, put PMT, put FV, put I by Y, put N, and compute PV. Do it on calculator, guys. Learn the TVM, right? That's why we are going slow initially, because these things initially takes time. And I told you, I've given you the sheet also, videos also. Just search for time value calculation, compute PV, it will come. Compute PV. Five things are there. PMT. I've actually written the whole thing. Just you have to put it, and you will get the answer, right? So that is what it is. Okay. So explained you the logic also, explained you the formula also. Rest is your work. But if you still get stuck, please ask me tomorrow. I don't mind in the initial days, right? But you have to become good at this, guys. That's very very important. Okay. Now let's go back again to our slides and come back here if there is more question. Okay. So that is right. So we were here. Okay. So we were doing here, and this is what it is done, right? So this is the solution, right? They have not told you what to do by calculator, but I have already told you what to do by calculator. This solution, how do you get this answer to this? That I have told you, right? You have to get by financial calculator. I've told the values also in that one note sheet which I'll provide you. Okay, let's go ahead. Again, another practice question. Grave. Okay, let's also copy this and take it there, because this will not allow me to write so much. I'll provide you this sheet also, so that will help you. So let's go back again. Okay, fine. So now you have this part, right? This we have to do. Now in this part, okay, we have the, what are we trying to find out here? Read the question. The question says, Gray Pebble Real Estate seeks a fully amortizing fixed rate 5-year mortgage loan to finance 75% of the purchase price of a residential building that cost NZD, New Zealand dollar 5 million. The annual mortgage rate is 4.8%, right? Annual mortgage rate. Okay. The monthly payment for this mortgage would be closest to what? Again, very typical kind of question, right? And that is where CFA, it's very important to solve CFA question, because if you don't solve CFA question, if you go and solve Phasor question, etc., you will suddenly find those are very easy. Now, this question is asking you, how do you find the monthly payment, right? Okay. See, when you have to find the monthly payment, right? First of all, the question comes is that, sir, where exactly have we studied monthly payments till now, right? So if you remember, we had a small discussion about your annuity, right? Annuity and annuity payment, right? So that uh, annuity payment is your EMIs, right? That annuity payment is EMI. So let me click that as well. I don't want to do up and down, but I want to show you this small thing, that this is the logic which is working here. This is what uh, is given in your slides also. I have copy pasted that amortizing bonds are an example of annuity payment. See, this is, if you read it carefully, this question, it's a amortizing fixed rate 5-year mortgage loan, right? And they are trying to find the monthly payment. So it's a amortizing bond, and for an annuity, the you know, the whole thing is this R into PV 1 minus 1 plus R minus T. Now the question comes is, if that is the case, right? So first you have to remember this formula. If you don't remember this formula, you can't even start this question, right? There is no way you can make a head start in this question if you don't remember the exact formula. Now the question comes is that R is okay, right? R I can find, right? Even it is given in the question, right? T also I can find, right? What about this PV? How do I find the PV? Because the PV is now interesting, right? PV is very, very interesting. And how do I find the PV in this particular case, right? So if you look at the question, right, the question is saying, if you read this, question is saying, this real estate company seeks a fully amortizing fixed rate 5-year mortgage loan to finance 75% of the purchase price of a residential property that costs 75 million. So basically, the loan which they are taking is 75% of your 5 million, right? 75% of 5 million is what? Your 3 by 4, right? Of your 5 million. 3 by 4 of 5 million is what? 3 by 4 of 5 million is what will be the amount? 3.75, right? 3.75 will be the,
3.75 million.
yeah, 3.75 is the PV, right? 3.75 is the PV we are getting, right? So that part we are clear that okay, fine. So PV we have found out it is 3.75 million. Okay. Now the question comes is the annual mortgage rate is 4.8%, right? But we are not looking at the annual, right? We are asking the monthly thing, right? Again, I told you, right? The rate is given annual, but we are trying to find monthly, right? So convert the rate into monthly, which is 4.8 divided by 12, right? Which makes it what? Which is 0.4%, right?
0.04.
0.4%,
Oh,
right? 4.8,
0.4.
0.4%, right? So R is also found. Now, I told you the logic, same logic. If rate is divided by something, time period will be multiplied by that thing, right? So time period was what? Time period is what? 5 year. 5 years. So 5 into 12, 60. Okay. So this is what will be input in the formula, right? Rate will go at 0.4%, into PV will go at 3.75 million. You should add the zeros, whatever you 10 into 6. And then 1 minus 1 plus R. R is again 0.4%, right? T is minus 60. Then you have to solve this in calculator. Okay. So looks a very simple question, but I think the trick part here is that if you don't remember this formula, you can't even start the question, right? So that's the tricky part here. So focus on that, guys. Very, very important. If you don't have that grasp on the formula, things will not make sense, right? Otherwise, I don't think question has that much of what you say difficulty, right? I think that otherwise it is pretty straightforward. But again, you have to do such questions, guys. Do less question practice. That's why I told you in the first class also. The mantra to pass your CFA is CFA end of chapter questions. And that's why we have deliberately included CFA end of chapter questions. These are all high quality questions, which I told you to practice. So we are solving all high quality questions in class itself, right? So we are, you know, doing a good job. If you are struggling here, you are, if somebody, like, you obviously you have friends, etc., right? Some friend will say, oh, Shwetha, questions are so easy, don't bother. Shwetha, questions are very easy. These are CFA end of chapter questions. These are the real things which come in exam. This is what will make you pass. Do less question, but do these questions. That is my, that is my suggestion for everyone. I tell everyone that in CFA, it doesn't matter if you uh, solve further questions or not. What matters is if you solve the harder questions around. These are harder questions we should know. Okay. Next one, we have a small discussion on your what you say. Okay, fine. I think we have two more. Numerical will not be able to do, but at least we can do theory. Okay, because tomorrow also we have to cover a lot. Okay, so we can do a little bit of theory. Numerical will you can come back tomorrow little well prepared, and I can give you that home part homework, but we'll solve in class also, right? So, but let's do the theory and then stop for the day. Okay. Okay, fine. Now a little bit of theory. This we have done. Okay. Now we have to develop the understanding regarding your equity securities, preferred and common stocks, right? So if you see your alphabet, right? Google alphabet, right? Alphabet has some preferred stock and some common stock, right? Every company has that. So equity security stocks represent your ownership in a company. Unlike your bonds, they typically offer variable cash flows, dividends, and have no specified maturity date. Equity, equity are basically shares. Equity investors have a required return that makes them willing to own an equity share. Obviously, if you are entering into the share market, you are entering it because you want more return than your fixed income, right? This return is used as a discount rate to value your equity securities. The preferred stock, right? Preferred stock pays a fixed dividend that is stated as a percentage of its par value, right? So again, stocks are also two type. One is a preferred stock. Preferred stock has higher value. Preferred stock has more voting rights, right? So they have more weight. Common stock has residual claim, right? So preferred stock is something which has higher weight, and in preferred stock pays a fixed dividend that is stated as a percentage of its par value. Again, this is how it is written. Preferred stock dividend per period divided by your market's required return per period, right? This is your preferred stock divided by your dividend divided by your required the market required return. Common stock is a residual claim which company assets after it satisfy all other claims. It's a normal kind of stock which we people buy. We buy common stock. Common stock typically does not promise a fixed dividend payment. So normal people like retailers buy this. If you are a promoter of the company, you allot yourself preferred stock. Right? Preferred stock gives you extra dividends, extra voting rights. Their valuation methodology is different. So value of a preferred stock is dividend divided by the discount rate. Common stock does not promise a dividend. Instead, the company management decide when to pay common dividends. So that's announced, right? So simple logic, right? Nothing special. Now there is a valuation using your dividend discount model, right? There is a model. The name itself gives you an idea. Dividend discount. Basically, earlier you had discounted cash flow. Now it is dividend discount. Basically, you are discounting the dividend, right? How does it? So again, there are three approaches of dividend discount model, right? DDMs. So one assumes a constant future dividend. Under this, we can value a common stock the same way we value a preferred stock using the perpetuity formula, right? So same thing, DP by KP, right? Same way as a we can value a common stock same way as a preferred stock, DP by KP. Okay. Second is you assume see, this is a constant future dividend. Constant future dividend is constant. Next part is you assume a constant growth of dividend. Both are different, guys. This was dividend constant. Here, constant growth of dividend. Okay. So constant growth of dividend. With this assumption, we can apply the constant growth dividend discount model, which is also known as Gordon growth model. Again, don't go too deep in this model. This is the formula. What's the formula? V naught value of a, they will tell you in the exam, they will give you D1. D1 is dividend next period, guys. D0 is today, D1 is tomorrow, right? Next period. Tomorrow's dividend divided by your required rate of common equity minus your growth rate, right, on the common equity, right, GC. Okay, that is what we have, common equity and your constant growth rate. So that is also written as D1 can be written as D naught into your growth rate 1 plus G, right, divided by your K, which is the required return on the common equity minus your growth rate on this, right. Again, very simple. This is your common equity required return. This is your constant growth. Right. In this model, we not represent the present value of all the dividends in the future period, beginning with D1. Note that the KE must be greater than the GC. Again, just remember the formula. Come prepared. Tomorrow we will do it ahead. We'll not do the numerical today. So that is the part. So this is, you have seen there are three types here. Please understand. You have to read the question very carefully. If the question says constant dividend, then use this formula. If the question says constant growth, please remember, you have to read the wordings of the question very carefully. If the question says constant growth, right, then we have to go to this formula. One is constant dividend. Constant dividend. Constant dividend is not same as constant growth of dividend. This is constant dividend. Right? This is constant dividend. This is constant growth of dividend. Right, please understand very clearly, both are very different. So read it very carefully when you are solving the question. If one word you miss it, right, if you miss the word growth while reading, you will put the wrong formula, you will get the wrong answer, you know. And third one, there are three approaches. Now they have told you three approaches of dividend. Third approach is this: you assume a changing growth. Third approach is changing growth. So here we will use multi-stage dividend discount model, which assumes a pattern of dividends in the short term, such as period of high growth followed by a constant growth. Right. To use a multi-stage EDM, we discount the expected dividends in the short term as individual cash flow, then apply the constant growth DDM to the long run. The constant growth DDM gives us a value for an equity share once period before the DDM using the numerator. But we will solve this question, right? We will solve it tomorrow. You will not understand the multi-stage EDM till we do a question, because multi-stage EDM, unless somebody solves a question, will not be done. Basically, in multi-stage, what we are doing is we will divide the multi-stages into types. We will say, okay, this is short term, right? So short term will be different. Then we will say that okay, after short term there is a constant growth, right? So right, and then we will say that final value is. So what we will do is, this third approach is a mixture of previous two approaches. Third approach is a mixture of previous two approaches. So this third approach you can understand if you see the question, right, and solve it. So we have to actually solve the question to understand it, so which we'll do tomorrow. But that is very important to understand. Okay.
Is this also part of module 2?
No, module one only, right? This chapter is long, right? This is module one only. We are not able to complete today, but that's okay, right? So, but we are almost at the end, I think. Yeah, we are almost at the end. We only have to come back tomorrow and solve numericals, right? So you can take it as a home. If you're very excited, you can do this question, because this first numerical is your approach number two. First numerical solution is your constant growth. This is constant growth. Right. So this we will
I
do
think
tomorrow.
it's
This is
module.
easy numerical. Very easy
Time
numerical.
value of money in finance is module 2, right?
No, no, no. Module two is this one. Implied returns and cash flow additivity. Module one
Okay,
was
so the
just
dividend discount model is in module 1.
yeah, module one, right? Discount dividend discount model in this discounted cash flow value valuation inside this module one. Okay, so we are still doing module one. See, module one, if you see the part in the starting now. So dividend discount model DDM. We are doing the last part, topic number 4. Okay.
Okay, okay.
So no worries. We will do tomorrow. Only two numericals are. So if you read the theory tomorrow or tonight, whatever, whenever you get time, right? If you read the theory, right, and you come prepared a little bit tomorrow, then I don't think there should be any issue because whatever I theory I taught you, because this is very simple approach. Constant growth rate, direct formula. You have put this numerical will only take 5 minutes, but next numerical is your this numerical. This numerical is approach 3, multi-stage DDM. This is multi-stage DDM. This is approach 3, right? This is multi-stage DDM. So this numerical will take some time, which I want to do tomorrow, right? So this is multi-stage dividend discount model. So see here what is happening. First you are taking different. This is short-term approach. Then this is short-term. Then this is long-term, right? And then combining those together, you will get the final answer. But we'll study it tomorrow, right? So we'll study it tomorrow. You will not understand it till we solve the numerical little slowly, and after that we'll start the module 2. Okay, we'll not drag it, but come back at least prepared. Apart from these two numericals, everything is done. And apart from these two numericals, yeah, three approaches we have covered. I've explained you constant dividend approach, constant growth of dividend, and the third approach, which is a mixture of earlier two approaches, short term and constant growth, which we'll see the numericals, right? So which we'll do tomorrow. Okay. But again, tricky part. I'm not saying if you're doing for the first time, you will obviously feel that this is difficult, but it's okay, right? Keep practicing, keep solving question, and in your case the best thing is that we are doing all the CFA questions here. So what you have to do is you have to go back and understand it and maybe redo those on your own. If you are able to redo those on your own, you are totally fine, right? Okay. All right, let's go ahead. I think you guys can see the screen now, and we can continue ahead. Okay. So this is practice question number 3. Again, this is a numerical, not a very lengthy numerical. We will see step by step, and we'll try to analyze what to do here. Okay. So let's read the question first. Yeah. When you look at the question, it is Milandia, right? Milandia, right? Milandia Corporation. Hmm. Okay, fine. Milandia Corporation pays annual dividend. Milandia Corporation pays an annual dividend to its shareholder. Perfect. And its most recent, that's word, most recent payment was Canadian dollar 2.40, right? Most recent. Now the question comes is most recent is D1 or most recent is D naught, right? Because D naught is previous period, most recent is what, right? So this is where a lot of people get confused because this D naught and D1 confusion creates a lot of problem in exam, right? See, even if they call it most recent, it is the dividend which has been paid previously. Anytime you see a previous dividend, anytime you see a previous dividend, please keep in mind. See, it is even though they have tried to confuse you, they have tried to send most recent dividend, right? But it's a previous dividend, right? It has already happened in the past. So it's a previous dividend, so it is D naught, right? Please remember D1 is the next dividend. I'm telling you very clearly, this is the one of the common confusion in exam. D1 is next dividend. Previous dividend is D naught, right? So okay, fine. So we have got that. Okay, D naught is 2.40. Perfect. Analysts following Mile India expect the company's dividend. Okay, company's dividend to grow at a constant rate of 3%. Perfect. They want dividend to grow. So D1 is equal to D naught 1 plus G, which we studied yesterday also. So 2.40 1 plus, which is 3%, which is 0.03, right? So 2.40 multiplied by 1.03. Okay. And 24 into 3, 24 into 2.72? I think 2.72 or something, right? That's what it should be. What is it? 2.40 into 3 is 2.472, right? 2.472. Okay, so D1 is that per year in perpetuity. Okay, so it means this is the final one. This is what it is growing. There is no other growth rate, right? My India shareholder requires a return. Okay, so their requirement. Now, what do you mean by require a return? Right? Again, it is the investor's requirement of a return, right? Because anybody who is investing in a project, obviously, he will have some requirement of return, right? So, if you remember, the formula was V naught D1 KE minus GC. KE was required return. This was required return, and GC was your growth rate. So D1 is what? D1 is 2.472 divided by your KE. KE was is what? 8%, 0.08. GC is what? 3%, right? GC is 3%, 0.03. Right. So if you solve it, right, in a very simple way, 2.472 0.08 minus 0.03. Very straightforward, very easy, very simple. I told you, right? First question will not take much time because it is one of the simplest of the questions. So answer comes out as 49.44. Okay. So that should not be a problem. Your 49.44. Okay. Very straightforward, very easy. So this is done. I'm copy pasting the solution also so that you have kind of consolidated summary kind of thing at one place. Okay, so that is also I'm pasting. The next question will be tricky, right? Question will be tricky, and let's do that again. Chances of next question coming in exam is higher because this question is very easy, so I don't think there should be any issue. Next question, let's try to do it. I told you that this is single stage DDM, dividend discount model. That will be multiple stage DDM, right? So that will be little tricky to solve it. So if we take next this one, practice question 4. Okay. So let's try to solve this question now. Fine. Right. When we are solving this question, now if you read the question carefully, right? So first try to analyze this question. Suppose again Safe Company Mar India announces that it expects significant cash flow growth over the next 3 years. Okay, and now plans to increase its recent 2.40 dividend by 10% in each of the next 3 years. Okay, you are fine, right? So next 3 years, right? Next 3 years, they are saying that we want to increase, right? And increase its recent dividend by 10% in each of the 3 years, right? So if you see, so D naught was 2.40, D1 will be 2.40 into 1 plus zero point 0.10, right? D2 would be 2.40 into this 1.1, this 1.1 into 1.1 again. Why again? Because same logic, right? Every year your dividend is increasing by your 10%. And third year also, right? D3 equal to 2.40 into 1.1 into 1.1 into 1.1, right? This is what we have. Following the, now here the language is changing, right? Here the language is twisting, right? I would say. So what is happening here in the language? What is saying? Following the 10% growth period, Myland India is expected to grow its annual dividend by a constant 3% indefinitely, right? So you are now seeing that okay, there are two phases basically. Two phases. One phase is of high growth in dividends. One phase is on, you know, kind of constant 3% indefinitely. So one phase is 10%, another phase is 3%, right? I'll come to your questions now, don't worry, right? So there are two different phases of growth, right? That we have to understand. Okay. So yeah. So thank you. Let me complete it. Okay. So that is what we have, right? So there are two different phases, and now how do we solve it? Right? What's the logic we should apply? So second stage will again, right? Here the twist will come is that first 3 years you have a certain kind of dividend. Second, after 3 years, you have some other kind of dividend, right? So what you are doing is, if you put it very simply, what you are doing is that for first 3 years, right, you calculate the values. I think this value is 2.64. This value is 2.90, right? This value, next value is just, you know, just to save my time, I'm taking the values from the solution. The third value is 3.19, right? 3.19. Now, please note down that for second period, right? This is first period and this is second, right? Second period, you have to be very sure that for second period, right? This is like a D naught, right? Because what has happened is that you see yourself, right? First year, zero, first, second, and third. Now things change from here, third year onwards. But if I have to take the find out the value ahead, the this period will treat this as zero, na? So it will say that okay, if I have to apply the same logic, so I need to do what? If you remember, the formula was very simple. The formula was what? D1 KE minus GC. So D1 will be what? D naught into your 1 plus constant growth, KE minus GC. And D naught for this period is D3. So D3 is what? Right, D3 here is 3.19, 3.19 into your 1.03, 3% is this period. And then KE is what? What is the percent? Again, same percentage. 8% is the required return. 8% is the required return. And yeah, and your 0.08, 0.03. Right. So if you solve 3.19 into 1.03 uh, divided by your zero point 0.8 minus 0.03, it comes as 65.80. Right. So 65.80. So you get 65.80. Now what has happened is that basically an earlier case, in this case, you were getting kind of answer easily. But in this case, you will not get answer easily because what is happening is that you have like a four cash flows, right? You have 1 year, second year, third year, and fourth cash flow is for the indefinite period which is ahead. So this is 65.80, right, which is the fourth cash flow. 3.19, 2.90, 2.64. 3.19, 2.90, 2.64. Ultimately, when you consider this whole thing, right? When you try to consider this whole understanding, what you realize is that when you are getting three or four different cash flow, you have to take the present value, because ultimately you have to find the value today. Now, here you have your cash flows are coming at different times, and that's why its name is dividend discount model or discounted. We are studying in discounted cash flow, right? If I have to discount it now, this whole thing, so the whole logic is that okay, fine, let's discount it. 2.64 divided by 1.08, 2.90 discounted by 1.08 square, 3.19 discount by 1.08 cube, 65.80 discounted by 1.08 raised to power 4, right? So this is the value you will get, and this is the value is at 59 point something, right? 59.71, right? So I know this is little tricky. That's why I told you that time also that to understand this concept, you cannot do it unless you solve a question, right? So that's why we didn't do yesterday also. We were focusing more on theory, because this part can be understood only by solving a numerical, right? There is no other way to understand this part, and that is what I was saying that time also. Short term, long term, and eventually this is discounting of cash flows. This logic, right, was not there in the other questions, right? Because you see, in the previous question we were doing only this much, and we are focusing here only, right? We did this formula, right? We did only D1 KE minus GC. We're focusing only on 65.80, but here we have to focus on different cash flows, right? So a little tricky, but I'm pretty sure this is not that difficult. Okay. All right. Now let's go back to our theory, because now we have to again study the theory part. So we'll go back and we'll start the questions. We'll come back here. Okay.